many of you pay taxes? Raise your hand. Thank you. And how many of you would prefer not to pay taxes? Raise your hand. Thank you. And how many of you know somebody who cheats on their taxes so they don't pay taxes? Raise your hand. Thank you. I'm Tom Wheelwright. I'm here to tell you today, you don't have to cheat in order to not pay taxes. Now, I grew up in Salt Lake City, Utah, heart of Mormonism. And I spent, as a result, 2 years as a Mormon missionary, knocking on doors of all places, Paris, France. Now, I was very successful as a Mormon missionary. In 2 years, I converted 2 people. So I got used to rejection. In fact, you could say that that was really the start of my entrepreneurship training. Because if you can't handle rejection, you will never be successful as an entrepreneur. Think about why you bought gold in the first place. It wasn't just to have shiny metal sitting in a vault. It was for freedom, security, and long-term wealth. But here's the problem. Most gold just sits there. It doesn't grow. It doesn't pay you. And month after month, you're really no better off. Now, you're no worse off because gold tends to retain its value, but you're not better off. You're not adding ounces of gold. Monetary metals changes that. They make it possible to earn a real return paid in gold, so your ounces grow every single month. Imagine looking at your account and seeing more gold than you had the month before without adding a single dollar of capital. That's the dream. Owning an asset that protects your wealth and compounds it at the same time. So if you want your gold to do more than just sit still, go to monetary-metals.com/CPA and see how your ounces can finally start growing. That's monetary-metals.com/CPA. Now, for the last 35 years, I've dedicated my life to learning and studying the tax law. I have a master's of tax degree from the University of Texas at Austin. I developed and taught courses to thousands of CPAs and accountants when I was in the National Tax Department of Ernst & Young. I taught hundreds of Masters of Tax students as a professor at Arizona State University, have taught thousands and thousands of entrepreneurs and investors like yourself around the world how to permanently reduce your taxes. Now, as I travel around the world, I hear the same thing every place I go. You can't do that here. I'm going, seriously? I travel halfway around the world to teach you how to permanently reduce your taxes, and you tell me you can't do that here? Well, let me tell you, look around. How many of you know somebody who's doing that here, not paying taxes? How many suspect that there are some who are doing it legally even? Raise your hand. The reality is, it's up to you on whether or not you legally pay taxes. How many of you are willing to learn how to make more money and pay less taxes as an entrepreneur? Raise your hand. You're in the right place. So there's a reason that people tell me around the world, you can't do that here. And it's because of how they earn their money. Remember, there are 4 ways you can earn money. You can go to school and get a job and earn it as an employee. Or you can go to school, even more school, become a doctor, a lawyer, an accountant, and be a specialist or a small entrepreneur. Or you can be a big entrepreneur, a big business owner. Or you can earn it as a professional investor, a true entrepreneur. Now, interestingly enough, as I travel around the world, and it doesn't matter if it's Santiago, Chile, if it's Sydney, Australia, if it's Johannesburg, South Africa, or San Francisco, California, what I find is the tax rates are approximately the same depending on how you earn your money. So on average, around the world, if you earn your money as an employee, you're going to pay about 40% in taxes. Now, if you're going to then become a specialist, get even more education, and earn your money as a specialist, small entrepreneur, you're actually going to pay even a higher tax rate, 60% on average. Now, as you move, if you can move over here to the big business owner, the big entrepreneur, you can actually reduce your tax rate to 20%. But here's the magic. If you can move down here to being a professional investor, a true entrepreneur, you can actually reduce your tax rates to 0. Now, here's what happens with most people. They go to school and get a job. And to make even more money, they become a specialist, like a doctor or a lawyer. Or they go, I'm going to go to an entrepreneurship program. Most entrepreneurship programs around the world, in fact, every other entrepreneurship program besides EDP, the goal is to take you from here to here. Are you kidding me? In other words, the goal is to increase my tax rate? That's crazy. Why would you ever do that? Your job is not go from here to here. If you really want to reduce your tax rates, you really want to become wealthy, you have to go from here to here first. But then, as we teach in EDP, you have to go from here to here. And ultimately, you want to get to a 0 tax rate and ultimate wealth and be the ultimately true entrepreneur. You have to come down here. Now, let me give you an example of this. Here are a couple of high-profile people. You may recognize them in a couple of different of these quadrants of how they earn their money. Watch.
Or maybe he doesn't want the American people, all of you watching tonight, to know that he's paid nothing in federal taxes, because the only years that anybody's ever seen were a couple of years when he had to turn them over to state authorities when he was trying to get a casino license, and they showed he didn't pay any federal income tax. So if he's paid 0.
Did you hear that? Because he's smart. Donald Trump pays 0 tax because he's smart. So why would anybody want to come over here and stop here? This is Hillary. Now, I'm not for Trump or Hillary. I'm just telling you, Hillary, she's an attorney. She's a smart attorney. She's in a 60% tax bracket. That's all she's ever known. Of course, she's in a high tax bracket. And of course, Trump is in a 0 tax bracket. In fact, it would absolutely shock me if Donald Trump paid any taxes. He would have to have the worst tax advisors on the planet to pay any taxes because he lives over here. Why in the world would you want to live over here and stay small when you can live over here and pay lower taxes and make even more money? Now, don't want to leave anybody out here, so think about who's over here. This is our Mr. Obama. Great guy. When he ran for president, he ran against a fellow by the name of Mitt Romney. Romney lives over here. Romney paid 13% tax. Obama, he said he paid 30% tax. It was actually pretty low for an employee. But Obama's only known employment. So if all you know is here or here, then of course you can't do it here. But if you can get over here, which is your job in EDP is to move from here to here. And when you do that, you can pay 0 taxes. There's a reason that people don't want to go from here to here. And it's a single 4-letter word: fear. They're scared to death of moving from here to here. What are they scared to death most? They're scared to death of an audit. See, over here, these people rarely get an audit. These people get audits all the time. In fact, every year. I guarantee Donald Trump's business gets audited every single year by 2 different organizations, by the financial auditors and by the tax authorities. These people are scared to death of an audit. Maybe because they're cheating, probably because they're not used to it. See, you don't have to have a financial statement over here. You can live off of an income statement. You don't have to have a balance sheet. You don't have to have a statement of cash flows and all these other financial statements. Over here you do. You can't operate over here without a financial statement. You can't operate over here without an audit. So these people love an audit. It serves them. It's like going for a checkup with the dentist or the doctor. This is a good thing. You know where you are. You may be afraid of it. You may not like the process of it, but it's a good thing. That's why these people love being audited and know they're going to be audited every year. These people are scared to death. So it's true. Some people can't do it here. If you're stuck in the E as an employee or self-employed, you're not going to be able to do it here. The people who can do it are the people who are willing to move over here and over here. And with the right team around you, with the right instruction around you, you don't have to be afraid of this. Because remember that the real purpose of the tax law in your country is to provide incentives to business owners and investors. It's the reason for the law in the first place. The law would be 3 pages if it weren't for that. And it's thousands of pages to give these incentives to the business owners and investors. It's simply a matter of sit back, learn things that you don't know. Don't be afraid of making mistakes. These people aren't afraid of making mistakes. That's why they don't mind an audit. These people tend to be scared to death of making a mistake. There's no reason to fear as long as you do it legally. You get the education, you put the team around you, then the government is more than willing to be your partner. They'll contribute up to 40% for every investment you make. And it doesn't matter if it's real estate, energy, or business. Remember, the government wants you to create employment. So you partner with the government to create employment. And when you do that, the government gives you tax benefits. Or the government wants you to build real estate. They want you to build commercial properties. They want you to build residential properties. So they give you huge tax benefits. We call it depreciation or cost recovery. Huge tax benefits for building that real estate. The government wants you to use debt in your real estate and your business. So the government gives you tax breaks for using debt for your real estate and for your business. If you're over here, the government doesn't give you any tax breaks for debt. Only when you move over here. But the government wants you to succeed. See, the tax law is set up to help you become more wealthy, but you have to do what the government wants you to do. When you do, you make more money, you pay less tax, and you never have to lose sleep at night. Thank you. The average American loses 20 years of their life through taxes. What I'm going to show you next is how to take those 20 years back. The average person spends 20 years of their life working to pay taxes. Now, that doesn't mean that it's 20 years of working. It means that 20 years of their life is actually working to pay taxes. So it's not just money we're talking about when it comes to taxes, it's time. You know, money we can get back. We can make more of money. We can never make more of time. And so the time that you're wasting or giving to the government because you're working for taxes and not for yourself makes a huge difference in your life. Think about those 20 years you could devote to your family, to your friends, to your hobbies, to your lifestyle, to your business. So here's what I'm going to show you. I'm going to show you why it happens, 3 practical ways to buy back your time, and how the tax code actually want you to pay less taxes, and only if you know how to use it. So in the US and most developed countries, in an 8-hour workday, you're spending 2 hours and 40 minutes just to pay tax. That's 4 months of every year that you're working for the government. Ultimately, that adds up to 20 years of your life. We call that a prison sentence. That's 20 years of vacations not taken, businesses not built, investments not made, and time with your family gone. We've all heard time is money, but the real truth is money is time. When you lose money to taxes, you're not just giving up dollars. You're giving up time that money could have given you back. That's why tax strategy isn't just about saving money. It's about buying back your time. Now, here's strategy number 1. Turn your everyday expenses into business deductions. Here's the difference between an employee and a business owner. An employee gets taxed on their gross income. That's income before any deductions. A business owner gets taxed on their net income. That's income after deductions. So the first thing that's important is you own a business. Now that business could be a real estate investment business. It could be a Airbnb business, VRBO, or any short-term rental business. It could be a restaurant. It could be an online business. All of these businesses qualify. There are everyday expenses, though, in these businesses that you get to legally deduct. Here's 5 that most people miss. Number 1, home office. I cannot tell you how many times I've been on stage and asked people how many were told not to take a deduction. And a good 60, 70% of the people raise their hand. And I asked them, of those of you who raised your hands, how many of it was at a home office? And most of the hands stayed up. Now, here's the thing about home offices. Home offices are not just about deducting a portion of your home, which, by the way, and I go through this in my book, The Win-Win Wealth Strategy. Remember, you're spending this money anyway on your home. You're already spending money on the cost of the home, on the interest, on the taxes, on the upkeep, the repairs, the maintenance. You're spending all that money anyway. Why wouldn't you let the government pay for part of it? I think it's crazy that people don't take home office deductions. And why don't they take them? Because some uninformed accountant or tax preparer said, well, that's a red flag for the IRS. Do you know it's only a red flag for the IRS if you're a sole proprietor? If you actually are an S corporation or a partnership, it's not a red flag at all. In fact, there's nowhere to report that you have a home office. So you've got to follow the rules. The home office, the rules are really specific, okay? And watch for a separate video where we talk just about home office. But here's the other thing. If you have a home office, remember that a home office actually increases your automobile deduction. Well, why is that? Well, because remember that the first trip you take during the day is a commute and it's non-deductible. And the last trip you take during the day coming back to your home is also a commute, non-deductible. Well, what if your commute were the 30 feet from your kitchen to your home office at the first of your day, and then you take your second trip out to see your rental property, to see a client, or to go to your business office where you're meeting with clients or employees. And then your last trip of the day isn't the one where you come home, because what you're doing is you're not coming home. You're coming to your prime principal office, which is in your home. And then your commute is the 30 feet from your home office back to your kitchen. All right. And by the way, can you have both a home office and an office outside the home? The answer is unequivocally yes. There are specific rules on how to do that. Watch for my video on home office. I'll walk you through all of those specifics. Home office, number one. Number two, business travel. We've done an entire video on business travel. Don't forget that business travel is deductible if you meet the test for deducting it. Third is car expenses. This is where you can use, the mileage rate. And if you travel a lot of miles, business miles, probably the mileage rate's the best bet. 70% a mile right now. That's a big deduction, right? If you're traveling 30,000 miles a year, that's a $21,000 deduction. So that can be a pretty big deduction if you're traveling a lot of miles. Or you can do actual expenses, which if you travel very little like I do, I actually do most of my work in my home office. I travel from my home office to my studio where I am now, and that's about 30 feet. And so if you don't do a lot, then actual expenses is better. Business meals. Business meals are one of the most missed tax benefits of being in business. Why? Because we think it's only with business colleagues. What about when you take your spouse or your personal partner to dinner? If you're a business owner, I'll wager $100 that if you're a business owner and you take your spouse to dinner, you are talking about business at dinner. Now, not if you go every night, but remember, it's got to be ordinary and necessary. But if you take your spouse to dinner, say once a week, you're probably going to talk about business with your spouse. As long as you do and you document it properly, then it's going to be deductible. Finally, education. You get coaching. You hire a good CPA, do a tax strategy or a wealth strategy. You take courses for your business, all deductible. Now, I would suggest calling it continuing education, because the IRS is less likely to audit continuing education than if you call it a seminar. Just a little trick there. Okay, now here's how to do it right. First of all, you start an LLC, limited liability company. It's your side hustle. Okay, that's fine. Open a business bank account. You must have a business bank account, and you have to track everything with apps like MileIQ or Keeper Tax. There are all sorts of apps that you can use to track your business time. Okay, and what you're doing, your business expenses. So make sure you track everything. Also, make sure you keep corporate records like annual minutes. And if you're doing something big, like you're doing a big 2-week travel and it's going to be business, document that in minutes, right? So because you want to look big, even though you're actually small. So look like you're big. and do the things that the big companies would do. Remember, the IRS isn't your enemy. They actually want you to do these things as long as you do them the way they want you to do them. So strategy number 2, earn like an investor, not an employee. Remember, the highest tax income is earned income. Earned income means that you're paying ordinary income tax at the highest rates and you're paying Social Security tax. That's earned income. That's like a W-2. Now, then there's a type of income called portfolio or investment income, which is like dividend income or capital gains, which is taxed as low as 0 up to 20 or as high as 23.8%. Then there's passive income. Passive income is not like interest income. It's not like interest on a bond. Passive income under the tax law means that there's a business that you're invested in. It's a pass-through business like an S corporation or a partnership, and you're an owner in it, but you don't actually work in it. Passive. Now, here's why passive income is so important, because it's really easy to get passive deductions on things like real estate investment. So you want to be able to offset your income with those passive deductions, but passive deductions can only offset passive income. So you need passive income. You need passive income. So make sure that you're structuring your investments. And why does the government do this? Because what does the government want you to do? They want you to invest in things like real estate, business, agriculture, and energy. And those you're going to tend to invest in passively. Now, not your own business, that's going to be active, but somebody else's business. They'd like you to be that angel investor. They'd like you to help build that next great thing, okay? Whether it's AI or something else. You can actually get to 0 tax on passive income pretty easily with a good tax strategy. Now, let me show you how this works. If you flip a property, let's say you're in real estate. I'm going to go flip properties. That's earned income. Well, now I'm going to change it from earned income to ordinary income. How do I do that? I just do my flipping inside an S corporation. Now, all of a sudden, I'm not paying Social Security tax on 100% of my income. I'm only paid on the salary that I'm getting out of the S corporation. I can flip a property, but I flip those properties inside an S corporation. I don't do it in an LLC taxed as a partnership or a sole proprietorship. It's very important. LLC, if it's great to be an LLC, but taxed as an S corporation if you don't want to pay Social Security taxes. Now, let's say instead, I don't flip it. So I'm not going to put this one in an S corporation. I'm going to put this one in an LLC that's taxed as a partnership. I'm going to hold it for a year. I'm going to get rental income. That rental income is going to be passive. Now, when I sell it after a year and a day, it's going to be long-term capital gain. So it's going to be portfolio income taxed at that 0 to 20% or most at 23.8%. Okay. So I can even go one step better, which is when I sell it, I can do a 1031 exchange and not pay tax at all. So I can take it to 0. So I'm just converting my income from a high tax income, earned income, to a low tax or no tax income like passive income or a 1031 exchange. That's a conversion strategy. So remember, if you're going to be an S corporation, make sure you pay yourself a reasonable salary and make sure you combine it and optimize that salary so that you're also optimizing your qualified business income deduction, that 20%, soon to be 23% additional deduction that business owners get. Take the rest of the distributions, don't pay Social Security tax. That can save you 15% right off the top. Now, over 95% of the Internal Revenue Code is not about collecting taxes. It's actually a roadmap for reducing taxes. It's about giving you incentives to do things the government wants you to do. Here's 5 places the government will reward you. First, business, okay? Business is number 1, always number 1. By the way, that's true in the US and all over the world. Number 2, real estate. Number 3, oil and gas. Number 4, renewable energy. And number 5, agriculture. Now, if you like agriculture, I would actually put that back up as number 1 because agriculture actually has more tax benefits than any other classification of business, right? But remember, these are all businesses: real estate, oil and gas, renewable energy, agriculture, any other business. Job creation. That's why the government is incentivizing. They want food production, they want energy production, they want job production, and they want housing built. So that's why the government does this. These are not loopholes. When you hear loophole, run away, please. If loopholes are things that are mistakes in the law. And are there loopholes? Yes. Okay. Will we take advantage of a loophole on occasion? Sure. But why use a loophole that the IRS may challenge when you can use an incentive that the IRS is never going to challenge because it's exactly what the government wants you to do in the first place? And you document it. You're on all fours, as we call it in the tax profession, meaning that you are squarely within the law. Why take a risk when you don't have to? You can reduce your taxes as low as zero if you do what the government wants you to do. Now, what do you do right now? Get started. That's the first thing to do. Get some education and then start a business, start a side hustle, buy a franchise. Okay, invest in a franchise, another great way, or multi-level marketing. Okay, these are easy small businesses to start. Start with a business online. Okay, say an Amazon type business, right? Start a business. You've got to have a business first. Next, track your expenses. Make sure you're doing good bookkeeping, whether you're using QuickBooks, Xero, some other general ledger software, or, make sure you do like KeeperTax, MyLife, keep track of things. Use a spreadsheet if you need to. Just use an Excel spreadsheet. You're fine. Keep track of it. Save your receipts. Now, when you save your receipts, don't save the physical receipt, okay? Put your notations on the receipt, who, what, when, where, and how, right? Put the notations, scan it, and keep the scanned copy. The paper will fade, so you don't want to keep paper. Keep a scanned copy. Meet with a real tax advisor in the early part of the year, not just at the end of the year or on April 15th, please. Tax deductions happen every day. Tax planning happens every day. Tax returns happen once a year. So if all you want is tax returns, you're going to meet with the tax preparer once a year. If you want tax planning, you're going to meet with your tax advisor on a regular basis, preferably monthly, but no less than quarterly. Very important. And if you're getting pushback on these things from your tax advisor, maybe you need to upgrade your tax advisor. Maybe you need somebody who actually has read tax-free wealth, who subscribes to the ideals of tax-free wealth, that look, the tax law is a series of incentives. It's not, the IRS isn't just out to get you. Now, here's a bonus tip for you. Audit-proof your life. If you're worried about an IRS audit, I want you to write this down. I will never speak to the IRS. I will never speak to the IRS. That is not your job. That is my job. My job as a tax advisor is to speak to the IRS on your behalf. So don't ever speak to the IRS. Second of all, document. You've got to keep good documentation, okay? That means that if you have a business meeting, at a minimum, keep a calendar, right? Make notes, right? Who's the lunch with? Why did I take this trip? Just take 30 seconds. An hour or 30 seconds every time. Just keep good records. And then what's going to happen is if you do get an IRS audit, you're just going to hand those records over to the IRS and they're going to be fine. They're not going to complain. I represented somebody once, not a client of mine. She only became a client because she wanted me to help her with her IRS audit. Probably a mistake on my part, because the IRS auditor said, hey, there's no documentation here. There's nothing that suggests why this is business. Okay, so you got to keep the receipts. You got to document it. Okay, so look, taxes may be our biggest expense, also our most controllable expense. If you're paying high taxes, it's because you choose to pay high taxes. I know that's an uncomfortable thing but the reality is you're choosing not to learn about how to reduce your taxes. You're choosing not to have a good tax advisor. You're choosing, let's say, for example, take that business travel. You choose to take a vacation and not do any business. That is okay to choose that. It's okay to take a vacation, but you are choosing whether you pay tax or not on that business trip, whether you get a deduction or not. I make that choice all the time, but I know it's a choice. I am making the choice because I am well-versed in the tax law. I pay attention every single day. I pay attention to what credit card I use. I pay attention to how I document things. And when you do that, more and more of your daily expenses become deductible, which means less and less of your daily income becomes taxable. So let me ask you again, what would you do with an extra 20 years in your life? Longevity, I was just at a longevity conference. I saw an article in the Wall Street Journal just the other day on this. It's a big deal. People want to live 10 years longer. What if you could live 20 years longer without living a day longer? Get 20 years back without living a day longer. 20 years back of your life because you're doing what the government wants you to do, the way they want you to do it. You're following the rules, you're following the guidelines, but here's what you're doing. You're thinking about taxes every day of your life. Not in a bad way, but in a, hey, I can make this deductible. hey, I can make this non-taxable. Hey, I could pay less tax on this. And therefore, I end up paying far less taxes. I make way more money, pay way less tax, and get 20 years back in my life. It's possible. We do it every day. Here's what your CPA probably isn't telling you. With the right strategy, you can be deducting your meals, your travel, even part of your house legally. This isn't tax evasion, and it's not a tax loophole. It's tax education. Most people spend after-tax money and wonder why they can't get ahead. I mean, think about it. They're paying taxes, and then they're spending money and they're going, why don't I have anything left over? It's taxes. The wealthy don't do it that way. They spend their money before tax, not after tax, because they understand this one simple truth. If you want to change your tax, you have to change your facts. The tax law is based on your facts and circumstances. And if you do things the way the government wants you to do them, then you end up with a lower tax bill. So in this video, I'm going to show you exactly how to take things you already spend money on. This is not new things you're spending money on, but things you already spend money on, and make them legally deductible. Sound too good to be true? Well, we're not talking about gimmicks here. These aren't tricks. These are just strategies that the IRS condones. They're not saying don't do this. They're actually saying, here's how do you do this if you want to do this. If you're willing to take the effort to change your facts, we're willing to lower your tax. It's already in the tax law. Let's start with how the average taxpayer spends money. You earn income, you pay your taxes, and then what's left over is available for you to pay your expenses. Now, the wealthy, what I call super taxpayers, they do it very differently. They take what they earn, they take that money, then they spend the money, and they pay taxes on what's left over. Now, why is this important? Okay, so let's go through a very simple example here. Let's say you earn $100 and you have a 20% tax rate. Now, most people, if you're watching this, you've got at least a 20% tax rate. So you earn $100, you pay 20% tax, and then you have, or $20 in tax, then you have $80 left over to pay for expenses. What if you did it the way the super taxpayer did it? Then here's what would happen. You'd take $100, you'd spend the $20, then you'd be taxed on $80. So 20% of $80 is only $16. Get it? So instead of paying $20 in tax, you're only paying $16 in tax. Now, add a couple of zeros to that. Maybe let's start with just 2 zeros. Okay, instead of $4 you're saving, it's $400 you're saving, or more than that. So it's really significant savings when you start adding up every single thing you spend money on every single day. This is one of the keys for why the wealthy pay less tax than you do. And by doing things the way the government wants them to do, then they get to deduct their expenses before they pay tax. Now, if you have enough expenses, that means you can pay zero tax, right? That's exactly right. So I'm going to show you, I'm going to walk you through in this video exactly how to do this. So let's start with your home. Okay, so you've got a side hustle and you're doing some work there in probably a corner of your house, or you maybe got a room set aside to do a little your side business or your real estate investing, whatever. And you go, well, wait a minute, I'm doing this to make money. So if I'm doing something to make money, shouldn't there be a way to deduct what the expenses are in order to make money? So you've set aside a portion of your house to make money. So what the government says is, well, if it's exclusive, okay, you have to regularly use it, just not casually, but regular and exclusive just for a business or your professional investing, like real estate, for example, then you get to deduct a portion of everything in that house. Okay, so as an example, let's say that you have a cleaning person, or even better yet, everybody has utilities. And by the way, it doesn't matter whether you own your home or you rent an apartment, it's a portion of your expenses. So if your office is 10% of your home, then that means 10% of your home expenses really become deductible. That means 10% of your utilities. That means 10% of your internet. That means 10% of your weekly cleaning. It adds up. It's these little things that add up every day. So don't believe somebody who says, well, don't take a home office deduction because it's not worth it. It's not worth the trouble. I will tell you, I know of taxpayers that save thousands and thousands of dollars in taxes simply with the home office. So that's just one. What about your car? Well, I'm going to give you two little tips on your car. First of all, if you use your car to go meet a client, to go look for a property, for a business or investing purpose, a portion of that car is deductible. Now, IRS gives us two different ways to do it. One is we can just take a mileage rate. Now, the mileage rate is up over 70 cents a mile now. 70 cents for every mile you travel. Well, that means if you travel 100 miles, right, that's $70 of a deduction. You go, well, that's not very much, but that might be 100 miles in a day. What if you multiply that over weeks? Now, let's add this to the home office. Now, normally, the first trip you take every day is a commute, and the IRS considers that a personal expense. The last trip, when you're coming home, also is a commute. Let's say you have that home office, and you go to your home office in the morning. That's your commute, the 30 feet from your kitchen to your home office. And then from there, you go to see your first client. Then when you come home, you don't come home to your kitchen, you come home to your home office. All right, you're coming home to your home office. That last trip is also business use, so that's also deductible. And then it's the 30-foot trip to your kitchen from your home office that's your commute. See, so it's not just that you can take a deduction, it's that you can maximize your deduction. Don't forget, the wealthy are always maximizing their deductions. Next, what about meals? So a lot of people think, well, I'm going to lunch, I have to eat, therefore it's not deductible. And the reality is, the way the IRS looks at it is, that's true. Your portion of the meal isn't deductible. But let's say you pay for somebody else. All right, now is their portion of the meal deductible? And in fact, the IRS has made it simple. It's not, you don't have to separate it out between their portion and your portion. You just divide the bill in half. It's kind of like when you take somebody you go to dinner with somebody and you say, hey, let's split the bill. And, they had lobster and they had 3 different alcoholic beverages, and you had a soda and a sandwich, and you're splitting the bill in half. It's kind of the way it works also in the IRS, but in many cases, it's going to work in your favor. So it's just 50%, right? You get to take 50% of business meals. Now, what's a business meal? Now, a business meal is you have to have a discussion that's truly business related and truly business important, either before, during, or after the meal with that person that you're paying for, okay? And it's only meals, by the way. It's not entertainment. If you take somebody to a baseball game's not deductible, but the hot dog and the beer that you get at the baseball game, that is deductible, so long as you've discussed business before, during, or after the meal. Now, of course, you have to document it. I always say that if you pretend to document a business deduction, you get a pretend deduction. The IRS, first thing they're going to look at if they audit you is they're going to look at, did you document it? So what do you have to document? Well, it's really who, what, when, where, and why, right? Well, the where and the how much is that's all included on the receipt. So you're going to keep the receipt. Now, I suggest you actually scan the receipt, because if you hold on to the paper, it will eventually fade. And by the time the IRS comes around, it may be a blank piece of paper. So scan that receipt. Okay, the IRS will accept scanned copies. Then, right before you scan it, just write on it. Who are you with? What did you discuss? And what was the purpose of the discussion? Okay, so the when is already on the receipt, right? They usually have a time and date stamp on the receipt. And so that's already there. You just need to put, okay, we discussed this. Here's the business purpose. Now, let's say that once a week, you and your spouse go out for dinner. Well, if you're a business owner, my guess is every single week you're discussing business. I have never met a business owner that didn't discuss business with their spouse. When they take their spouse out to dinner, at least once a week, you're going to discuss business. I find that I've always found that that's very useful. Now, my first wife, who passed away a few years ago, she was a musician. She didn't know anything about business. She didn't want to know anything about business. She was a really good sounding board. And I actually found it really useful to talk to her about business and kind of run things by her. And that's why it's deductible, because it really is an expense that will help you increase your profitability of your side business, your investments, your full-time business, whatever that business is. Just remember, you don't get that if you're an employee. You have to have a business. What about your cell phone? Now, this is an interesting one. I'll bet you didn't know this. If your business provides you with a cell phone, you get a different deduction than if you use your personal cell phone for business. See, if you use your personal cell phone for business, then the business portion, you can submit an expense report to your business and get paid back. And you effectively get to deduct that because the business is deducting that and you're not picking up an income. But what if the business provides your cell phone? Well, now it's not taxable at all. In fact, the business gets a deduction as long as the primary purpose is, hey, we need you to have a cell phone, right? Which most businesses do require that. We need to have a cell phone, so we're going to provide you the cell phone. Well, what if it's your business? So your business buys your cell phone, pays for your cell phone expenses. The IRS says, well, the personal portion, that's a de minimis fringe benefit. We're not going to make you keep track of that. So if the business buys that, again, we are maximizing our deduction. We're not just changing our personal, might otherwise be a personal expense, our cell phone, to a business expense by using it for business purposes. We're actually changing it from a portion of being deductible to the entire thing being deductible simply by who buys the cell phone and who pays for the cell phone expense, the monthly expense. So that's an easy one. And if you're not doing that, here's my gift to you. Next, what about education? So education is an interesting one. The IRS says that seminars are not deductible. However, there's a caveat, and that is continuing education is deductible. So let's say that you have a online business. This is your side hustle, and you go to a real estate seminar. Is that deductible? Well, it's not really continuing education, is it, for your side business? Unless at that real estate seminar, they're talking about general economics. They're talking about what's going on in the economy. They might be talking about what's going on in the tax law. I speak at a lot of those seminars. Well, then it might actually be continuing education for your business. Now you're going to have to prove that. On the other hand, if you had a real estate business, you are a true professional real estate investor, and you go to a seminar for real estate, continuing education, absolutely. So here's another way that you enhance your deductibility. I hate seeing on a tax return at a seminar or seminars as an expense. Rather, what I want to see is continuing education. If I put seminar down, I guarantee you the IRS is going to challenge that on an audit. If I put continuing education down, they may or may not challenge it. But the reality is that as long as it's there to enhance your current business, not a new business, that would be a startup cost, but you're a new business, then that's deductible. Again, as long as you document the who, what, when, where, and why. Now, what about travel? Travel's a big one. Travel is an interesting one because you really have to make a choice. Kind of like with the meals, you have to choose, do I really want to talk about business tonight? Honey, I'm tired of talking about business. Let's not talk about business. Okay, then you made a choice to make it non-deductible. At least it's your choice. It's not just because you don't know, right? Ignorance does not help when it comes to taxes. Ignorance is the biggest hindrance to taxes. So what about travel? Well, travel is interesting. If you're traveling within the United States, then all you have to do is make sure that more than half a day, every day that you're traveling, is in business. And if it is, that means that it's the primary purpose was business, and it means that 100% of your travel is deductible. Now, it doesn't make your spouse's travel deductible, doesn't make your kids' travel deductible. It makes your travel deductible. So do you want to spend 4.5 hours a day? Well, you go, well, I'm going to be on my computer anyway, 4.5 hours a day, so I'm going to count that. No, because you didn't travel so that you could use your computer. You could have done that at home. There has to be a business reason. The primary reason for traveling was business. So you might be meeting with potential clients. You might be meeting with business colleagues. You might be, if you're in real estate, looking for real estate. You can absolutely create that business purpose if you want to. Now, for me, there's 2 weeks a year. I don't want to do business. I'm on vacation. I want that vacation. I need that vacation. I have to have that vacation. I do not do business during that 2 weeks. I choose for it not to be deductible. I have a choice because I know that if I were to spend the time. Now, by the way, in domestic travel, within the 48 states. And in domestic travel, it's an all or nothing. But when you're traveling international, it's proportionate, which means that if I spend 2 days out of 5 of my travel doing business, then 2 out of 5 or 40% is deductible. All right. So there's a difference for international
than there is domestic. Domestic is all or nothing. International is proportionate. So just keep that in mind. Now, what about your family? This is number 7. And I mean, these are a lot of tips. Let me tell you, it's a lot in one video. But what about your family? I find your family is one of the greatest opportunities to create deductions for money you would otherwise spend anyway, okay? And get a deduction for it. How do you do this? Well, let's say you take your kids and you put them to work in your business and you pay your kids. Did you know that in 2025, the first $15,750 that you pay to your kids is not taxable to them? They have a 0 tax rate for that because they get a standard deduction for earned income. They don't get a standard deduction for investment income. That one's a lot lower. But for earned income, they get the full standard deduction. So think about paying them $15,000. Go back to that 20% tax bracket. Now you're talking about $3,000 to put in your pocket. Well, but wait a minute, what are you gonna do with that $15,000? You're not just gonna hand them $15,000. Well, a couple of things that have to happen. First of all, they actually have to do the work and they have to be worth $15,000. Okay, so if they do work worth $3,000, then you pay them $3,000. Again, you may not want that going in their pocket. Where does it go? There are a couple of options. One is it can, of course, go into a bank account, a savings account for them. I'll tell you in a later video why I think that's a bad idea, but it could go into a savings account for them. They could actually put it into a 401k or an IRA, right? They could actually put it into another plan, like a Roth IRA. Well, I mean, what a great idea. Put it into a Roth IRA. They didn't pay tax on it, so it doesn't matter. They didn't get a deduction and it grows tax-free for the rest of their life. Put it into a Roth IRA. But what else could you do? Well, what if you were a real estate investor? Couldn't you invest in your real estate through a family limited partnership? Sure you could. Could they invest in that partnership? Of course they could. Now, there are limitations on what minority children can do. So make sure you talk to your advisors about how to structure this properly, because contract you enter into with minority is voidable. So frequently you need to use a trust, or you might have to use a particular type of bank account for your child, okay, that you're the custodian of. So there's some make sure you follow the details. Remember, in taxes, it really comes down to the details. You must dot your I's, you must cross your T's, else I guarantee you, when the IRS comes knocking, you will not get that deduction. And you do need to justify that they are actually working. Now, why would Congress do that? They actually have a pretty good incentive for it, and I'm a good example of this. Okay, I grew up in a family business. I started working at my dad's business when I was 12, and I worked all the way through high school. Well, in high school, I worked in the accounting department. I am now a professional accountant. So that doesn't always happen. My brother worked in the press room. It was a print shop. And in the press room, he learned all sorts of things, but here's what he did, is he understood what was going on in the business. Now, we got paid for it. Now, in that case, we got paid. My parents didn't believe in giving us an allowance, okay? We had to work. So this was the way we earned our money, but they provided the job for us. It's good for children to learn how to work. It's good children to learn how to work in the family business. There's all sorts of good things about children working in a family business. And it's good for the parents, it's good for the business, and it's good for the children. So there is good public policy behind this particular provision of the tax law. Now, interestingly enough, this is the case all over the world. I was in South Africa a number of years ago, and I had a South African tax advisor on stage with me. And I presented this idea to the audience, and I turned to her, and she was a really good tax advisor. And I said, so what do you think? Could you do that in South Africa? She looks at me, she goes, well, yeah, we could do that. It's like she hadn't thought of it. And that's fair enough. I'm telling you things that a lot of accountants don't know. So just make sure you take advantage of that. Now, you want to make all these deductions audit proof, because the IRS is a little dubious, you can imagine, of personal expenses that you've turned into business expenses. Well, what's the key here? The key here is documentation, documentation, documentation. Just remember that there are 4 rules for a deduction to be qualified as a business deduction. First is, there must be a business purpose to it. Second of all, it must be ordinary, meaning typical in your business. Third, it must be profitable. The intent must be to create a profit for you. So, and fourth, it must be properly documented. Who, what, when, where, and why. Now think about that. If you never spent money that wasn't profitable, documented, have a business purpose, and ordinary in your course of business, wouldn't you make more money? I think so. So see, the tax law is not just a roadmap for reducing taxes. It's actually the best roadmap ever created for building massive amounts of wealth. So keep your receipts, document who, what, when, where, and why. Put your effort towards these deductions, and just remember, everything that you spend could be deductible. Become a super taxpayer. Do it like the wealthy. I'm not saying to cheat. I want to be really clear. None of this is cheating. We're not cutting any corners here. We're doing exactly what the IRS and Congress wants us to do. So what are we doing is we're planning every single day. If you look at my book, Tax Free Wealth, you'll see some little things I do. For example, I have a credit card in my business. I like to pay with a credit card from the business. What does that mean? I don't have to get reimbursed by the business. You know, there's a lot of things I don't have to do. It just makes it easier, but I have to be careful. I can only use that business credit card for business. So when you start a business, even a small one, just remember, you're unlocking an entire side of the tax law that's written specifically for entrepreneurs and investors. So take a look at this example, the side-by-side example in this chart here of what happens between an employee and a small business owner with these different expenses. Just remember, when you change your facts, you can change your tax. So how does this new tax law impact business owners and investors?
President Trump's tax and spending cuts bill passed a key House hurdle. This comes after a GOP deal broke a budget committee deadlock.
Well, I've been a CPA for 45 years dealing solely with entrepreneurs and investors, and I've looked through this bill in great detail as it stands right now. And there's some really good things for businesses. First of all, it retains the 21% corporate tax rate. Well, you think, well, I'm a small business. I'm not organized as a corporation. Maybe now is the time to think about maybe you should be organized as a corporation, because there are some tax benefits for corporations, 21% tax bracket, that you don't get if you're a pass-through. However, there's something really good in this new tax bill for pass-through entities. Pass-through entity is like a sole proprietorship, a partnership, or an S corporation. LLC's tax is one of those. Pass-through entities are really important to small business. And the reason the pass-through entities are so important is because most small business owners, they take their money out of the business. They don't leave it in the business. You want to be a C corporation if you leave a lot of money in the business. Of course, remember, it's 21% in the business, but when you take it out, you pay another dividend tax. That's actually a tax change I would like to see, where you're not taxed on dividends, or the corporation gets a deduction for dividends. One of those two, they really ought to consider putting in a tax bill sometime soon. That would really help the business community. But for now, we get a double tax when we're in a C corporation. So it only works if you're going to leave a lot of money and build up that corporation and then sell the corporation later. However, let's say you're a pass-through. So you're an S corporation or a partnership, or heaven forbid, a sole proprietor. Please don't be a sole proprietorship. Please don't do that. That's a Schedule C. You're ripe for audit. Please don't do that. Okay. So you want to be, if you have a regular operating business, you're going to want to be an S corporation or a C corporation. S corporation if you take a lot of money out of your business, or C corporation if you leave a lot of money in your business. It's that simple. Now, in an S corporation, under this new bill, not only do we get the 20% pass-through deduction made permanent, which means the top rate with a pass-through deduction it's a 20%, means you're really only being taxed at 29.6% instead of that 37% rate. But under this bill, the proposal is to increase that rate from 20% to 23%. So it's an even better tax benefit for small business owners who want to operate as an S corporation. Now, one of the negatives is these high tax states. One of the things they're looking at is, do they want to eliminate the state and local tax deduction that pass-through entities get? And they are looking at that really hard. So let's watch that very carefully, because that could be a serious offset to that 23% tax deduction that you're getting. Then all of a sudden you're paying taxes on top of taxes because you don't get your pass-through tax deduction. That would be bad. All right, so the 23%, that's a really good thing. So that means that, first of all, please, please, please don't be a Schedule C. Let's be an S corporation. Then when you're an S corporation, you have to figure out, how much salary am I going to pay? Because remember that salary is subject to Social Security taxes. Distributions from an S corporation are not subject to Social Security tax. So the inclination is, well, let's make my salary as low as possible. However, remember the pass-through entity deduction requires that you pay salary. So what you want to do is you want to sit down with your CPA and actually figure out how to maximize your pass-through entity deduction while minimizing the Social Security taxes you pay. So it's always, like I say, you always have to run the numbers. If you want to know what's going on, you need to run the numbers, because it may be that you need to change your facts. As I always like to say, change your facts, change your tax. So if you want to change your tax, you have to modify and be careful about what your salary is coming out of your S corporation. Again, you don't want it to be zero, because then the IRS could come in and assert, hey, we're going to treat all your distributions as salary because you treated none of it. And it seems to me like, you're just doing all the work yourself. Therefore, 100% should be treated as salary. So you really put yourself at a high risk if you take 100% as distributions. So instead, figure out how to make the most of both that 23% deduction and minimizing your Social Security taxes. So that's something that we want to watch out in the new bill. Now, I'd mentioned in another video that we have change in the solar tax credit and the automobile tax credit. Here's where you have to look at the effective date. Now, that's not a term that's used a lot in your everyday life. What's the effective date of this bill? Well, under the bill as it was originally proposed, the effective date for the $7,500 electric car credit is the end of this year. It's the end of 2025. So that means you want to buy your electric car now, okay? Don't wait until 2026. However, if they change that effective date, they could change it to today. So the sooner you take action, if you're planning on buying an electric car sometime this year, you might want to consider doing it now. All right. They're also talking about eliminating that tax credit for leases. Okay. So if you want to lease an electric car, you want to do that right away, but you might want to actually consider buying that electric car, because that $7,500 tax credit may not apply to leases in the future. Second of all, let's say you're in a sunshine state like I am in Arizona, and you are thinking, well, let's put solar on our house, or better yet, what I love, let's put solar on our office building that we own, or let's put solar on our rental properties. Okay. Because the tax credit is 30%. It's 30% of the cost. And because of the bonus depreciation coming back, remember, your solar panels are equipment if they're on your business property. So either on a rental property or on your business building, not on your personal residence. This doesn't happen in a personal residence. But let's say that you're putting it on your commercial building or on your rental property. Well, now you get a 30% tax credit, but you also get bonus depreciation. And the bonus depreciation provisions, the effective date, there's that term again, the effective date is the beginning of 2025, whereas it looks like the effective date for the solar is going to be after 2025. So they're going to take it down after 2025. That means that if you put it up this year, you might get both a deduction of 85%, it's not the whole 100%, but 85% of the cost. So if you put $100,000 of solar, you're getting an $85,000 deduction and a $30,000 credit. That means the government's paying for roughly 2/3 of the cost of your solar installation. And if it's offsetting your electricity costs, which of course in Arizona, we have high air conditioning costs in the summer, you put in the battery, you put on the solar, government to pay for 2/3 of it, but you get all the benefit. So that is very, very cool opportunity, but that's something you need to act now. You cannot wait to act on that because it takes a long time. You've got regulations at your city or your county, sometimes at your state, what you can do with solar, maybe even your homeowners association, what you can do. So you need to get started right now. If you're thinking about putting on solar panels, this is the time to do that. There are some other renewables that are similar to that. You might be thinking about putting in some charging stations, right? It's charging equipment somewhere. A few years back, ATMs were the big rage, right? They were going in all over the place, and they were all independently owned for the most part, except for the ones at the bank, right? They're independently owned ATMs. And then there were the cell towers, right? That was a big thing that everybody was going into. Well, today it might be the charging station, and the charging station might be something that you want to get in right now because that credit's going to go away. So if you're going to do one of these things, solar panels, charging station, electric car, you probably want to do it right now. There are some other things. The effective date might be after this year. Okay. Typically, if it's after this year, it's because it's going against the taxpayer. And if it's good for the taxpayer, it's going in earlier. Now, what we don't know yet, we won't know what the effective date is for the tips. My guess is it'll be 2026 being tax deductible, or the overtime being tax deductible, or the car interest being deductible. Those things may wait until 2026, but who knows? So watch that really carefully. There are things you want to do. Now, the most important thing as a business owner and an investor, you want to pay such close attention because your taxes are your wages, are your single biggest expense, and they will put the biggest drag on building your wealth and how much money you have available to you to put back into your business to grow your business. So first of all, please make sure you're not a Schedule C. Do not do that under any circumstance. I used to think it was okay if you weren't making very much money, but what I've found is that the IRS loves to audit Schedule C. So if you don't want an IRS audit, don't do a Schedule C. Second of all, the tax benefits, remember a Schedule C, you pay a self-employment tax or Social Security taxes on 100% of your income. If you're an S corporation, it's only on your salary. So you want to be an S corporation or a C corporation, depends on, am I keeping money in the business or am I going to take all the money out of the business? Now, if you are keeping your money in the business, there's another great tax strategy that we probably ought to do a whole video on called Section 1202, which basically allows you to sell your business tax-free. Yeah, you heard that. If you're a C corporation, you can't do this as an S corporation. If you're a C corporation, you can potentially sell your business tax-free after 5 years if you do follow all the rules for Section 1202. Now, if your accountant hasn't been talking to you about this stuff, you might want to get a second opinion. Talk to an accountant, that's a referral. Talk to an accountant that you trust. Talk to somebody you know. And when you do that, then maybe get a feel. Are they really doing things in my best interest, or are they just trying to protect themselves? This is why I wrote the book, Tax-Free Wealth. I wrote that book so that you could know enough to know whether your accountant was actually doing the things that they should be doing, which in my mind, your CPA, your accountant should be your primary advisor when it comes to your business. They should be your primary business advisor. And if they're not, again, maybe think twice, maybe get a second opinion, and maybe it's time to scale up and get a better accountant.